In this week's podcast episode, I talked to Dr. Alexis Eisenhofer, the founding partner and managing director of Financial.com. We talk about how Financial.com was founded, the traditional financial and monetary system, the current inflation, and maybe what you can do about inflation, and of course, cryptocurrencies.
It comes to an end when the sum of all financial assets is higher than the sum of all real assets. And financial assets basically speaks about bonds and bills, treasury bills. And if we see the debt of governments, this will not be repaid. And this is so much, and we have aging demographies, so it's not going to be repaid. And if people realize that they won't get repaid their assets, they will sell their assets. And if it comes to the point when they sell their financial assets and switch to real assets, this will accelerate inflation. And this is the tipping point. I am fearing that we are not so far away from this.
He has built up a global fintech with Financial.com, and at the same time, he's strongly committed to Munich as a financial center, which is why it is an honor for me to welcome on today's episode Dr. Eisenhofer.
Yeah, thank you for having me.
Shall we jump right into the interview?
Yes, please.
My first question is always, who are you and what do you do?
Yeah, my name is Alexis Eisenhofer. I'm 48 years old. And I've been working in the financial services industry for 31 years. I graduated from Ludwig Maximilians University in Munich. I majored in capital markets, wrote my PhD on portfolio optimization, and then I started this business, Financial.com, in 1999. So actually we are fintech from the last century or even millennium.
This is so great. And I also read your post on Instagram about the founding story of Financial.com. But for those who don't know yet, could you tell us how it all started?
Yeah, actually, it was a team of 4 founders, and I came in third. The 2 founders, Christian Hamp and Christina Brandl, they started by just developing an option calculator, and Christina, she was donated a picture, a painting, because her grandfather was mayor of Murnau, a nice city in north. Near the Alps, and she sold actually this picture for. There was an auction on Christie's, and this picture was sold for, I don't get the right number, 200 something thousand, and this was basically the money that we used to buy the domain name Financial.com because we wanted to host a financial portal. We started in a niche, and our business idea was basically to calculate Greeks, the so-called Greeks, the financial figures for options on the fly, because in the mid-90s, financial derivatives became accessible for retail clients, and there was only one print magazine. It was a monthly magazine, and it was already outdated when it was printed, because all the markets had moved, and so we thought it might be a good idea to calculate the financial figures on the fly, and we registered the domain name optionsscheine.de or options.de, and then we built an interactive warrant simulator. And this was a niche market for self-directed investors and sophisticated self-directed investors. And we were glad to have 3 advertisers, very loyal. One was Goldman Sachs, then UniCredit and Societe Generale. But it was a niche, and then we thought of how can we grow this, and we wanted to grow this both across asset classes and internationally. And then we thought of having this domain name Financial.com would be a nice platform. We had no idea what this brings, so actually, it turned out that we were really unsuccessful in running a financial portal. We had 400 euros overall in revenues, and we couldn't bear the costs. So this was the reason why we quickly closed the portal. And we were the first to display Reuters, which is now Refinitiv, Reuters quotes in the internet. And so, because we had no money, we had developed the software to display the data ourselves. And then Reuters asked us to shut down the portal and just to serve their clients to enter the B2B market. And so we ended up building financial portals for Citigroup, Credit Suisse, Daimler Chrysler Bank, and many others. And from this point, we then moved into the paid content space, B2B, wealth management advisors, and compliance managers, and all these finance professionals. And over the course of the last 2 decades, we've grown the company to a decent size of 140 people. We have 5 offices around the globe, 11 and a half time zones. And we have many clients, mostly large financial institutions, where we develop and host customized solutions. We run them on our premises. So basically, we were cloud before cloud services came. And so we have developed customized solutions. So we are aiming, or we are developing solutions for the long term. We have long-standing relationships with banks, and it's a lot of effort to develop a platform. But if you've done it, then it's pretty stable. We have 90% recurring revenues, and it's a software as a service business. It's not fancy. It's not sexy. We're not on top of the newspaper, but we are actually not on the last paper as well. So we are running smoothly, and we are behind big firms. We're smoothing the data flow between Refinitiv customers, big banks, and so we feel very comfortable with this.
So I think what you built is indeed fancy. I think it's a great company and it's very interesting. Also because I worked with Refinitiv Icon in the investment bank, and I had some problems with the database sometimes, and I was curious what you do with the data, because as far as I know, you're you're putting more value to the data, right? So are you adding more data, or do you have a own database with which you compare the data to see if everything is correct, or how can I imagine it?
Yes. There's actually, I could give you some insights into the development of the industry by telling you this story. And when I first entered the door at Reuters, Reuters was the one and only company serving the financial market. It was like 50 or 60% market share. And it was in 2000. And at that time, I know that we just celebrated the 150th anniversary of Reuters in Frankfurt. And I mean, Bloomberg, they started in 1981. And how could they grow as big as Reuters? And the reason was in 1981, Reuters was a news agency, and Bloomberg started the terminal business. And then Reuters grew the terminal business and ended up with 90% revenues in terminals. So actually, it was a tea company by the end of the century, and it was run by journalists. And then at that point, they made a decision that was totally the opposite to Bloomberg. Bloomberg was a mainframe core. So they just you sent your query to the Bloomberg server to New York, and then they sent you some replies. Refinitiv or Reuters, they sold you the feeds, and they sold you the lines. So then you had everything on your premise, and you could display the content at your site and filter everything. So Reuters was the partner of choice for trading floors, because if you wanted to filter quotes on your site, speed was all you need, and it was said that 200 milliseconds was set to be real time. And and then the world changed. There were more and more computers sending quotes, more and more instruments. So there were so many ticks. I mean, I think in 2007, no, it was 2013, I guess. There was the first second with more than 100,000 ticks per second, yeah, in the Amazon stock. Yeah, so computers not processing data but also producing data. So way too much data. So there was a limit on the bandwidth of the line, and so yeah, if you have these decentralized architecture, you needed to filter things away. So a Japanese broker was not interested in German stocks, German options, and the other way around. So Refinitiv partnered with us to add some additions to their global offering. So it was us, yeah, serving the German option traders, yeah, and saving bandwidth, yeah, and in 2000 and I would say 2010, 11, something around this, this co-location business came into the trading floor. So you needed to host, or you needed to place your computer in the data center of the exchange, because the light, yeah, it takes 1 nanosecond to travel 30 centimeters. So it's all about speed. And if you are not in this in the exchange data center, you would only end in second. So you couldn't win a trade. So this co-location business has changed the market data industry. So what was 200 milliseconds, what was real time, is now historic data, because humans, yeah, would always see historic data because machines would have traded this anyway. So the need for latency, yeah, for technical, for machine trading was huge, but for computers, for humans, for wealth managers, was getting, yeah, less important. And more important was then yeah, harmonizing the data, and yeah, adding research and, yeah, workflows. So, and this was where Bloomberg was pretty good. So then the disadvantage of Bloomberg turned into an advantage. Yeah? And over the years, Refinitiv has catched up. They have centralized their IT. Yeah? They have built own cloud services, own platforms. And we were, yeah, in the middle of this discussion, because we started as a web company, yeah, and building websites means that you need to cache data, you need to harmonize data, because I mean, we have only one template to display a quote, yeah, and if this quote comes from the Deutsche Börse, it would be different to the field from the Milano Stock Exchange. Yeah? So, and we have to, we build a fit swapper, we call it fit swapper, field identifier, and we swap this so that the quote would only always be displayed at the same position on the website. So harmonizing the data, technically speaking, caching this data for easy and quick access was key to building a nice user experience. And so we were, yeah, the guys for a nice user experience, cool front ends, algorithms. Yeah, so we built something on top. If people ask me, what are you doing for Refinitiv? And I always quote, or I always tell them, we are like the AMG to Mercedes. Yeah, we are like the AMG to Refinitiv. So if you want to be on top of the curve, if you want to win the race, you need to have 10 horsepower more than your competition. And it's likely that we can build you the 10 horsepower. So it's not only, it's technical stuff that we have, a lot of experience and speed and delivery. And it's also adding, yeah, financial calculations. I mean, I did my PhD in multi-period portfolio optimization, option pricing. So there's nothing we can not implement, I would say. But we use libraries, of course. We implement customized algorithms. We have a huge community asking us questions, and so there's always a lot of feedback, yeah, that brings us further. Yeah.
This is so interesting. And I think it was also you who told me that the prices near the Deutsche Börse, for example, for room or for apartments and offices are quite high, because a lot of these quant traders are sitting next to the exchanges because they really want the space for their trades to work, right?
Yes. I mean, I have a friend who's a professor of finance, and he is into this algo trading. And he once presented me a study where they compete in the range of 5 to 8 nanoseconds. So it's, I said, 1 nanosecond is 30 centimeters and yeah, speed of light. And so you can imagine that it's a 2 to 10 meter cable. Yeah. So to have a level playing field, everyone needs a 10-meter cable. Yeah. So because yeah, the proximity is that important. Yeah. And the reason, I mean, this sounds so ridiculous. I mean, if people from outside the financial industry talk about algo trading, is it good, is it bad? There's a lot of blame, yeah, and the reason for this is. In total, algo trading is super. Yeah, I mean, people fly over the ocean with an autopilot in the night. They don't see anything, but they trust in the machine. Yeah, but when it comes to trading, everyone is fearing bad things. Yeah, and the reason why people are complaining for algo trading and saying this is not good is basically that it's a winner takes it all game. Yeah, it's Goldman Sachs and Timber Hill or Interactive Brokers, yeah, getting the chunk out of it, and all the others lose. Yeah, and who's losing? Yeah, maybe big financial institution. I don't want to name someone, but you can imagine that there's many losers and few winners. Yeah? And these losers talk to politicians and say, "Hey, how crazy is this? I mean, how can this be? I mean, the average holding period for a stock in North America is around about 22 seconds. Yeah, because there's so many people flipping stocks, and the reason for this is. Algo trading is very good for retail clients who cannot research the market because they cannot compare quotes from different exchange places. And algo traders would they would aggregate the order flow and they would offer the best bid ask spread. Yeah, and if there's an algo in the order book, you can be sure that this is the best order you will get as a retail client. So if you have a best order, buy and sell order, and if you hit an algo, it's good. It's to your benefit. Yeah. But if you're an informed trader, a pension fund, a big bank, yeah, and you have research costs, yeah, you benefit from large spreads. Yeah. And if there's someone jumping in your spread, yeah, and narrowing down the spread, yeah, this will bring down your margin. And if this comes to a certain extent, you cannot refinance your research, yeah, because if the spread is very narrow, yeah, you cannot pay your analysts, yeah. So for the retail client, for all of us, yeah, algo trading is very, very good. But for few people, yeah, for big banks, not refunding their research, it's bad. And these banks or these non-algo traders, they leave the market and they trade in dark pools. And this is the only threat, yeah, of algos, yeah, because pushing big research, big smart money away into dark pools, because a dark pool is something that it's not public. It's not where you can say it's not market efficiency that you can see there. So information is not public, and the difference between a dark pool and an exchange is an exchange is a order driven market. Yeah, you have an order book. You can see what's the bid and ask, and what do I need to get executed. And a dark pool is a price driven book. So by the way, the first dark pool was Instinet. It was started by Reuters, yeah, in I think in 2000, and they said, well, we will have an overnight trading session, and we will offer the closing price for some stocks. Yeah, and if you are a hedge or if you're a fund owning 10 million shares in Daimler, you could say, I want to sell 10 million shares in Daimler at the price of, I don't know where they currently trade, at maybe 30. Yeah, and then you could be sure that you would get this price, but you could not be sure to get an execution. So this was a certain price, but an uncertain execution. A stock market gives you a certain execution, but an uncertain price, because you can, if you place a block order, yeah, with no limits, yeah, you just, yeah, you get executed and you will get crashed by many algos, and the price might drop some 1 or 2%, because there's a lot of liquidity in an order book, and so the difference is certain execution, uncertain price versus uncertain execution, certain price, and so pushing big and smart money away to dark pools is cautious, and this is not good for the financial markets. I don't know the exact numbers, but I guess 10% of the trades are conducted in dark pools and over the counter, and so having trades public is good, and so this is, yeah, at a certain extent, algo trading is not good in this respect, but there are initiatives to, yeah, how say, to ease or to have a more fair trading, yeah, because at a certain point, or there was a message. I think it was Goldman Sachs. They were so smart and so quick. They could place an order and withdraw this order before others could hit the order. So and then the others reacted, and by seeing their reaction, they could know what is their trading strategy. So it was like this. Needle that they needle strategy. They just annoyed the others, and and now people think that you have to have at least I don't know 1 second or 10 seconds validity of this order. So you cannot have bulk uploads of thousands of quotes and then restore everything. So you need to commit yourself for a certain time period. And I think it's clear that we need to be fair, we need to be transparent, but overall it's to the benefit of retail clients. And if politicians say, well, I'm doing something for the small pockets, they should really foster algo trading.
Talking about retail clients and maybe what's best for the people, um, let's say on a high level, I also wanted to ask you some few questions about the current monetary system, because since a lot of my listeners are interested in cryptocurrencies and there are some rumors always, I wanted to ask you as an expert. How you see if there's a concrete connection between money supply and inflation, because I heard some experts say there is no connection between the money supply and the inflation, and a lot of the inflation we currently have is due to the supply chains, and I just wanted to know your opinion on this.
It's not. It's not. I mean, it's a liquidity trap. Yeah. If you talk to economists, so they would say we know what's happening right now, but I mean, speaking about cryptocurrencies, yeah. Just let me elaborate on this a little bit. I mean, there's two groups in cryptocurrencies. Yeah, the classic financial industry thinks Bitcoin is a huge nonsense. Yeah, and non-financial people love Bitcoin, and yeah, they think or they believe that this will replace the old system. Yeah, I see myself a little bit in between. Yeah. It's obvious that Bitcoin is not a payment instrument. I mean, technically speaking, you can only, I think, transact 10 transactions per second, something like this. Yeah, and it's not a legal tender. Yeah, so you cannot. Yeah, it's not official. Yeah, it's something invented by someone, Mr. Katoshi Satomoto or some. I think this is his name or the pseudonym. And so this is not a payment instrument, and there are also no interests that you get paid. Objectively, I can therefore understand the financial industry, and I'm also skeptical. Yeah, but I think, or I share the opinion of Robert Schiller, yeah, the Nobel laureate, and he wrote a book that I can highly recommend. It's called Narrative Economics, and he's got a chapter in it about Bitcoin, and he says Bitcoin is a sexy narrative that many people follow, yeah, because. I mean, everyone. I mean, if you see the comments on Facebook or in some news groups, everyone is blaming bankers. Everyone is blaming the financial industry, and having something against it is sexy. Yeah? They say it's old-fashioned. I mean, seeing the ATM machines 50 years old, it's not so fancy as your iPhone. Yeah? And so they say, oh, let's get away from the old financial industry. And technology is something very appealing. It's the future. People see that algorithms are taking over. You can trade with the phone in your hand. You don't need to see a bank. So it's sexy. It's the future, and people want to be part of the future. So this is why people are attracted by Bitcoin, and so it's a great narrative, and this somehow attracts a lot of people, and having a global phenomenon is good. But I think a narrative is like a pandemic. Yeah, it comes in some waves. Yeah, and over the long ride, the waves will be smaller. Yeah, because there's always people. Yeah. You lose people if there's a crash, and you have to replicate your narrative. You have to say, well, I'm about to become the payment system, and if you've not done it over the last 10 years, people get critical. Yeah, and you cannot store value, and there's governments banning Bitcoin. Yeah, I think the Chinese or the Russian they consider banning Bitcoin. Yeah, it's the payment of choice in the darknet for criminals. Yeah, and we have 1% of the almost 1% of the world's electricity is spent on mining Bitcoin. Yeah, in times of climate change, I think that's not a good idea. Yeah, and by the way, the US they spend 18 plus billion US for their military. Although Mexico and Canada are very friendly nations, yeah, so they want to secure the dominance of the dollar and as the world currency and secure their own values, and they definitely have no interest in getting. Decentral software taking over their money supply. So I think there's a lot of threat to Bitcoin. By the way, people loving the Bitcoin, they always tell me, hey, it's limited to 21 million. I think it's the current supply is some 17 or 18 million, but the algorithm doesn't allow more than 21. And but yeah, I mean, this is also causing problems. I mean.
You can increase it. So I had on last week's or on today's week's podcast episode a developer of Peercoin, and he is like they're the lead developer, and he was very early and has, I think, more than 10 years experience in this space. And basically you can make a fork, and he says it will also probably happen because at some point when all these Bitcoins are mined, the miners want to get, of course, their costs or their money back for the electricity and the hardware. And one option would be that the transaction costs would increase, which would be bad for the ecosystem, of course. Or the other option would be that there's an update to the blockchain, basically like a fork, which also happened to Ethereum. And this is something where I think, okay, everybody says these blockchains are so stable, but if the community wants it, and I don't know what is always called the community, and if it is really so decentralized as a lot of people are saying, or if there are like major mining corporations, it would be possible to create more than 21 million Bitcoins. And I'm always, I think you have very good arguments, and I'm a little bit in between because I don't know how to see it. And as you also told us, there will probably never be a currency which can compete with the US dollar, because I think one currency which could have been a real threat was the Facebook Libra project, where they had all the big banks on the project, and they got so much pressure from all the regulators that this project was shut down.
Yeah. Interesting. I didn't know that. Yeah, but I mean, given the fact that there are already over 10,000 cryptocurrencies, yeah, all claiming to be the one and only. There's so much inflation in cryptocurrencies. Yeah, I mean, every day there are, I don't know, 100 new cryptocurrencies. Yeah, and I mean, you can, of course, you can argue whether central banks are good or bad. I don't want to cherish the ECB or the Fed, yeah, but the fact that a growing quantity of goods, yeah, needs a growing quantity of money is indisputable. Yeah? And if the world consisted only of bitcoins, yeah, and given the fact that this is limited to, or is limited to 21 million, yeah, this would be a deflationary currency, yeah, and a deflationary currency would mean, yeah, that all goods would become cheaper tomorrow, because more goods would meet the same amount of money, and therefore it would be reasonable or wise to buy nothing today and wait for the cheaper price tomorrow. Yeah, and an economy with a deflationary currency would then would end in a deflationary spiral. Yeah, and so a world with a deflationary currency does not work. Yeah, so by this would economists would tell you this story. Yeah, so having a growing amount of goods needs a growing amount of money. Yeah, and coming to your question, yeah, how does the money supply, yeah, result in inflation? Currently, people or politicians talk about or blaming the Russian war, yeah, and of course there might be some impacts, but the inflation that we see today comes from something different, yeah. Just to give you some rough estimation or rough numbers, I mean, 12 years ago, well, no, it was like 13 and a half years ago when we saw Lehman crushing, yeah, and all the Western central banks, they started printing money, yeah, in huge amounts. I think the balance sheet of the ECB, of the European Central Bank, has grown by, well, it's sevenfold at least, and I think it could grow to ninefold or something if we price in all the measures. Yeah, so they started with their quantitative easing. They bought bonds. Yeah, and the Fed, they did it something similar, and I think even more aggressively. Yeah, so having all this money supply, yeah, buying bills, yeah, treasury bills, means that they have financed deficits, for nations. Yeah? And I mean, we can see that roughly 5 billion euro balance sheet that come from the quantitative easing program of the ECB have grown. At least 80% of their balance sheet was higher debt ratios of the country. So this money has been spent. Yeah, this was income for people that they wanted to support. Yeah, I mean, during the pandemic, we've seen restaurant owners or travel agencies losing money, but they got support, yeah, at least to a certain extent, yeah. And on the other side, there were people saving on restaurants and saving on travels, yeah. So in some, there's more money in the system, and now we have the broken supply chain. I mean, we see the zero COVID policy in China, where they just force big ships to stop in Shanghai and wait for the quarantine, and so this is breaking supply. So what we currently see is a stagflation scenario. So the supply is limited due to lack of resources, be it oil, be it wood, I don't know, or labor, and on the other hand, it's the pre-production goods that you need. So it's a limited amount of goods, seeing more demand because people saved during COVID. Yeah, and now politicians, they always think short term, but or only in niche. Yeah, what we see is now today they voted for 100 billion euro military budget. Yeah, and from a emotional angle, I would say yes. Of course, we need to strengthen our military. I mean, seeing the conflict in Ukraine is terrible. Yeah, but yeah, speaking from a inflationary perspective, this will end. This is government spending. Yeah, so spending 100 billion will increase the inflation. Having a minimum wage. I mean, we all want people to get along with their income. Yeah, and having a minimal wage is politically it's a good idea, but this will also cause inflation. Yeah. And then, why haven't we seen inflation over the last 10 years? And my explanation is that we have, I would say, a demographic overlap. We have the baby boomers in their best years saving for retirement. And so there's a lot of savers and only few people selling bonds. But this will change, yeah, in the next, decade or starting this year. The first baby boomers will enter retirement, and so they will start selling bonds, and there's only few people buying bonds because we can see that this year I think in total we will lose 300,000 people in the workforce. So now it's a tipping point, and what we see now is that we can not hide away problems in the financial system. I mean, if you have so much savings coming in, savings glut, some researchers always thought it's a savings glut. If you have so much money, you could pay everything. You can rescue everyone and everywhere, and it doesn't matter because no one is asking for money. But if it comes to the point where more people are wanting their money back than new people putting money in the system, you will struggle. So from a demographic point of view, the game will change. And what we've also seen is that there's a lot of money just being stored in the liquidity trap, so to speak. So people do not have investment ideas because the whole world gets dematerialized. By the way, the Greens, they or the Grünen, they always say, "Hey, why do we need growth?" And so much. Uh, uh, yeah, resources, and I can recommend the book "Less for More," from Brynjolfsson, MIT researcher, and he said, no, what we see is that growth is becoming more and more dematerialized. If you see the iPhone, a little phone can now do the things of a camera, a photo, computer, so many things in just one device. So things are getting dematerialized. And I mean, if you see the most valued companies is Google, Facebook, Apple, all these IT giants, and it's the brain of the people. It's not their computers. If you would intrude California and fight against all and steal away the PCs, you would have nothing of value. 100 years ago, it was you could steal gold, resources, and this was the store of value. But now it's more in the head of the people. It's human capital. So this has changed as well. So you have not so many capital intensive industries where you could put this money to work. So there's a lot of money on the sideline. And now what we see is if in psychology is, I would say, 90% of the market. And if people think of an inflation, it's even too late because this changes the expectation. And if the expectation is inflation, they will price in this expectation, and this is some self-fulfilling prophecy. If people are now starting to sell bonds, this will cause trouble. I mean, what we've seen is the the hike in the interest rate, the Fed reserve, the rate, this I think I don't know the exact number right now, but some hundred basis points, and this has caused a drop of all US Treasury bonds of 10%. Yeah, and given the debt of treasuries, I think this was some 3 to 4 billion US dollars market value loss. Yeah, so and this has to be borne by someone, and it's financial institutions, and if they have such a big loss in what is used to be, or what used to be safe assets, because in drop in market value, this causes trouble for the financial system. So and so inflation is all around, and I think it's very dangerous. And yesterday, I mean, the ECB, they made their first hike, 25 basis points for an inflation rate of 8.1%. I mean, it's like fighting a fire with a little I don't know. It's nothing that would solve the problem. Yeah, it's something very very concerning. Yeah, and so I don't see a solution to the inflation. And by the way, in the long term, it's always an inflation. I can highly recommend Ray Dalio. Yeah, he's a very smart guy in our industry, and he's 72 years old, and he started publishing books and producing videos to share his knowledge, because he said, I've come to the age where I just want to share my knowledge. Yeah, and he's got a video on YouTube which I would say it's the best I've seen on YouTube. It's 30 minutes how the economic machinery works. Yeah, and there he says we have the super cycle, and the super cycle is 7 to 100 years, and it comes to an end when the sum of all financial assets is higher than the sum of all real assets. And financial assets basically speaks about bonds and bills, treasury bills. And if we see the debt of governments, this will not be repaid. Yeah, and this is so much, and we have aging demographies, so it's not going to be repaid. Yeah, and if people realize that they won't get repaid their assets, they will sell their assets. And if it comes to the point when they sell their financial assets and switch to real assets, this will this will accelerate inflation. And this is the tipping point. I am fearing that we are not so far away from this. Yeah.
And there are only also limited options what can be done, right? Because the interest rate can only be so high because we have a lot of states which would probably default if we increase the interest rate to, let's say, 5% or something like that.
Exactly. It would be. I don't have the right number, but I mean, I would say it would be at least the majority of the Eurozone. Yeah, and so if it's a political decision with a majority taking control, then you wouldn't see something. Yeah.
And I think it's also a problem for society, because a lot of people who are young like me, they are thinking how can they build wealth maybe over time, and also how to afford maybe a own house or something. And I was thinking a lot about this, and I was also looking at the financial industry. And now I'm working in the tech industry, and let's say they are paying definitely above average. But it's also hard in a city like Munich or in other cities to afford a house or a flat anywhere in your lifetime. Maybe with a partner it is possible, but if you're not maybe an entrepreneur, or maybe in the 1% or 0.1% of the earners, it will not be possible. And I think this will also lead to frustration in the society in the long term, especially when the inflation cannot be fixed.
Yeah. I can 100% understand what you're talking about. Yeah. Let me just I mean, I love to work with young people, and we hire a lot of young people, and it's great. And the people that we have are really committed. But I can see something that concerns me. And one was this factor that you just mentioned, that they cannot afford housing. And I think there's a big disappointment, that comes from a pledge that our parents or our parents gave us. If you get a degree from a good university, you will get a good job. You can make your own living. You will be good, well off. So you can afford everything you want to. Yeah, I mean, my father. Yeah, he was the first Studienstiftler or Fulbright scholar with a scholarship for the MIT, and he was. He had a chance to become a professor at Harvard, but he then decided to come back to Germany. But he was in his age group in 1960. He was outstanding, and in his education was he had 3 degrees, university, best grade. For me, it was clear. Okay, from an education perspective, he's outstanding. Yeah, and if people told me you need to, build your own career, to go to university and do the same, I said, yes, I've seen this with my dad. But now everyone has a university degree. Everyone is well educated. So there's no edge that you have over the others. Yeah? And what I can see that and this is a disappointment. This is a not given, not solved promise. Yeah, and I can see with the workers, they are disappointed also, because I mean the graduates, they get the same amount of money for their work as the workers, and they are unhappy, and the workers, they are unhappy because it's the smart academia guys having the narratives, talking smart, having I mean they come in the office with a chai tea latte, speaking 5 languages, knowing 20 cities. Yeah, so they have I would say. Uh, they are the storytellers, and they bore the workers, And so the workers, they are working hard for their living, and so they are somehow they now everyone thinks of going to university and work. Just being a constructor is poor, and so this annoys workers, and all these academia people, they do not see their benefit. Yeah? So this is something where I could say, hey, there's a lot of disappointment. Yeah? So and the second is, I mean, we have so many people, seeking secure high incomes, and we live in a VUCA world, volatile, uncertain, ambiguous, and and complex, and this is reality, and you cannot be safe in a VUCA world. You need to take risks, and you need to be aware of that, And I can recommend the book. It's not too academic. It's Rich Dad Poor Dad, written by a Havanian guy. His father was a very smart professor, and he said, "Hey, my father was one of the smartest in the room, but he was poor. And the father of his friend, he was very dumb, but he was rich." Yeah, and I said, "What's the difference?" And he said, "The difference between people poor and rich is the poor people, they think in terms of income sheets. What can I afford me? Yeah? And the rich people think in terms of balance sheets. How can I finance it? Yeah." And if I see the real estate market right now, I mean, the level is still high, but we have a real negative interest rate of, I don't know, for the bunds, it's 7% negative real interest rate. Yeah. So if you can get a financing for 20-25 years for a house, and I don't know, I have a mortgage for 2.17%, and now I see inflation of 8%. So every year I earn tax-free wealth of 6% of the capital that I've invested. So there's not only opportunities on the assets in your balance sheet, but also opportunities on the liability side. And what you need to do in an inflationary world, you need to get debt, yeah, and invest in good assets. Good assets would be the MSCI World Index, of course. So there you can expect some 6% per year. I mean, 3% is the annual growth rate of the economy globally because of population growth, and 3% is the dividend yield. So adding up, it's 6%. This is, I would say, the intrinsic value of the MSCI World Index. Yeah, and if you have something, if you have liabilities of 2%, yeah, you have a 4% margin. Yeah, the obstacle is that I mean, real estate is very sexy because it's, I would say, it's the hedge fund for the retail investor, yeah, because it's so easy to get loans, yeah, mortgages, and so if you want to have a loan for your stock portfolio, it's much harder, and the rates are not that good, and so investing in real estate is still a good idea, yeah, but you need to take risk and you need to think for the long term, yeah. Compounding is so key, yeah, to your long-term financial wealth, yeah. And you can start as early as you can. I mean, I was 17, yeah. Warren Buffett was 11. So you need to start early, yeah, and then compound as good as you can, yeah, and take each and every opportunity. And by the way, an opportunity will come when the opportunity wants to, and not if when you have money. So having money and desperately seeking for investments is a bad idea. Yeah, you have to be calm. You have to be humble. You have to take action when it's a good opportunity. And then I would say it's a dozen opportunities that are really interesting that everyone gets in during his life or her life. Yeah, so just be, yeah, responsive and take action when it's needed. Yeah, and so you can still, yeah, earn a housing and make a good living. By the way, I just read research some weeks ago. 3 decades ago, it wasn't easier to buy a house, yeah, because I mean, they have compounded, or they have compared the salary of a professor, yeah, which was is said to be the best earning position in public with a good education, and this is a transparent salary. And they compared the salary 30 years ago and now, and the interest rates and the house prices, and they said it was always tough, yeah, to finance housing. Yeah, so because people often compare yesterday's prices with today's interest rates, but it's, or with today's salaries, and you have to be clear that yeah.
But I think purchasing power did sink over time, right? So with the houses.
Yeah, yeah, it depends. I mean, a house is nothing. It's not brick and mortar that you pay. Yeah, it's the price that you pay is keeping others away. So there's a limited space and a lot of competition for this limited space. So this is the reason why there's so many euros coming in. Yeah, and a generation ago, it was one salary that could make a living for a whole family. Today, we have at least the parents both having full-time jobs in Munich. Yeah, and they cannot afford houses as big as their parents, yeah, because now everyone has two salaries and everyone wants a house, and there's only the same space available. Uh, so you have no edge over others, and the same amount of space. And I really wonder why no one is seeing what is apparent. Yeah, it's obvious that we should, yeah, build more stories in a building, yeah, because if there's a limited area, you can only add a room if you have more stories, yeah, and so. But then, if it comes to a 10-story building, there's so much such a shitstorm. Yeah? People are starting campaigns, and no one wants a neighborhood with a 10-story building. Yeah, but this is the same as getting all the diligent workers out of the city. I mean, policemen, police officers, women, I don't know, nurses. Yeah, they cannot afford a living in Munich because there are people, yeah, thinking of a nice, yeah, scenery. Yeah? And I would say, hey, that's not fair. Let's talk about the real thing. And the real thing is we need to add more apartments. Yeah.
You can do it also like in Singapore, where it is also quite clean and very safe.
Yeah.
And I think high buildings shouldn't be always connected with, let's say, criminality or some other things, because I think you just have to do it right. But for the end, as you told me, you have limited time.
Yeah.
I really like your optimistic view on the future. I think taking risks is probably key. On the one side, investing, and maybe also to be entrepreneurial in one way or the other. I think financing maybe real estate for your personal wealth is also a little bit like an entrepreneurial activity. And maybe let's look more optimistic into the future and try to see the good opportunities coming ahead, and not only trying to see them, but also trying to seize them in the future.
Absolutely. I feel privileged to live in these days. The speed of innovation has never been greater, and it's the best time. Yeah. So don't worry. If you're young, be happy. Don't worry. The future will be yours. Yeah.
Thank you so much for the interview, Dr. Eisenhofer. It was a pleasure.
My pleasure. Thank you very much, Sebastian. Thank you.
Thanks for listening on today's episode. If you like the podcast, you would really help me by recommending it to your friends, because the thing is, podcasts don't get really any organically reach, and I'm reliable on the community to build a community. And yeah, I would really love if you maybe have someone who's interested in Web3 and also listens to podcasts, if you share this podcast with them. I'm also always happy for feedback, so the best way at the moment would be probably over LinkedIn. So maybe you have some recommendations for me. Until then, have a nice day. Cheers.